Hello, hello. This is not financial advice. This is just for entertainment purposes only. I don't know what it is, but for some reason, sometimes I like to make videos to respond to a question, and my audience is one person. Don't know if this is best use of time, but here we go. So, Big Boy, Big Boy Vapes Inc., fantastic name, was asking about should I buy puts on an ABT to cover my shares? They're really panicked over the Mexico-Canada tariffs, and I feel uncertainty here is going to make for a rough earnings call despite any good news. And that's a fair question, right? I don't know your cost base. Oh, before I forget, Big Boy Vapes Inc., regardless if you like my video or not, friggin' like it, all right? Because I put the time in. So before I went on that, that's a fair question, right? But here's where and look, I don't know what I'm talking about, so don't take my discussion for any sort of you know wisdom or knowledge, right? But look, if you look at the 120 line, right, it tapped, and so the lowest it got in this recent kind of chaos was 120.47. It's up here. I couldn't really drop 120.47. So what? Fuck it. Anyway, 120.47. And you'll see that here back in, what dates are these? Back in November 27, back on November 6, and around this date, it it was oh my God, it was rejected at these points, right? And so eventually, they use these like supports. Sometimes supports become resistances, or sometimes resistances become supports, meaning this, which used to be resistance, is now possibly a support level because it bounced off of there. All right. So in a moment of panic, it bounced, it touched off here and supported. No guarantee. I guess it looks like, close this, that the last earnings was, stop doing that. This is the earnings. So the earnings is in October. And so the earnings hit last time, it was right around this level. The max it kind of got to was 119.85. So around 120. Okay. So if you were thinking about buying, put options to cover your shares, that's fine. That's like a defensive type of thing you could do. But you have two issues that you're going up against right now. One is the just overall volatility. Hold on. All right, you got the VIX. You got volatility that's still elevated. Yeah, it's not up here at the 60s, but still pretty elevated. It looks like I was checking the earnings on Thursday, I think, or something like that. And depending on what the news is on Monday, right, VIX could, well, state of the obvious, go up, go down, or stay the same. But it's elevated. It's elevated over sort of the more normal levels. I mean, more normal levels are kind of 15-ish, you know what I mean? So right now we're almost 3.5 times what sort of normal, or at least what the recent normal's been. If you go back to June 2023, right? It looks like, hold on a second, like normal's kind of like in that range, I guess, right? 12 to 16-ish. Seems like most of the volatility has been sitting in this range, right? But as of late, it has been escalating. So you'll see like 23, but still we're above normal recent volatility. Okay. But then you also have the volatility of the individual stock because uh, around earnings dates, and I'm sure you know this, volatility increases just around earnings dates. So you have two types of volatility. Okay, I'm making this shit up as I go. But you got two types of volatility working against you. You got the volatility of the market in general, and then you got the volatility related to earnings. Okay, so if you go to this thing called bar chart, it's free. There's something called IVR, which is like volatility rank. It kind of tells you like how is the volatility relative to its normal, and your stock's not on here, but it'll say like IVR rank. What does this mean? This means I had an explanation earlier. Uh, the at the money average applied volatility, blah blah. Rank is 100% means the IV is at the highest level over the past 1 year. Okay, so which makes sense. Volatility is crazy right now, but you can see these companies are all at 100. It's pretty high volatility. And then I picked up, I searched specifically for Abbott for you, and it's at 98%. So we're at super high volatility. What am I trying to get at with this meaning? It means that basically Options are expensive right now. They are pricey. That's the bottom line I'm trying to get to, is that the insurance that you want to buy is expensive. And once again, this is not financial advice. I'm just talking about this because I enjoy sort of talking about stuff that I don't know about. So yeah, I fucking use Robinhood. Shut up. All right. So if you were trying to pick a strike for buying puts to protect your position, it depends, right? You want to buy at the money puts. It's like 127. It's going to cost you $400 to protect. Okay, and the issue here is that uh, let's say Abbott collapses, right? Let's say it loses some money, right? I mean, and you should be used to it because the market's been crazy. Your Abbott stock's been losing value these last few days because of the volatility and the craziness. I mean, were you planning on selling Abbott soon? Is that why you have a lot of money in there? You plan on liquidating it for buying a house or something like that? Because I imagine that when things settle down, Abbott being a good company, that you could eventually recover, right? Abbott pays a dividend. Eventually, over time, it should recover its share value. I hope. I don't know. I'm not promising you anything. And so you can ask yourself why you're buying insurance. Because if it's because you need the money soon, I get it. But if that's the case, maybe you just sell the stock now then, right? But if not, then I don't really know why you buy insurance, because even if you lose value on paper, it should come back. If the craziness calms down, I don't know how. Okay, I don't want to ramble on, but hopefully you get my point. Right? How long are you going to hold the stock for? If this is a forever stock, maybe you're better off taking this money that you would have used to buy a put and just buy stock should it drop at earnings. Okay. Now, another way to do it is to say, it hit 120 and you didn't sell then. So it seems like you're okay if Abbott is at $120. Well, if that's the case, maybe you want to come down here and buy, puts at 120, right? It's cheaper. It's only $183. Or if you think you could stomach a bit more, if it's just because you don't want to have it hit like down to $100, if that $27 drop right from here to 100 is just too much for you. Okay, maybe you buy some insurance further down. Okay, possibly. Okay, but once again, you're paying for the volatility. These are expensive compared to how they normally are priced for the 2 points earlier about volatility, right? The market in general and it being earnings. Now, if you still wanted to buy something and you wanted to buy some cheaper insurance, rather than, and let's say you're worried at 120 it's going to be a problem, then maybe you could buy put debit spreads, right? Debit put spreads. Or you could buy the 120, you could sell the 119. Hold on. And what do I mean? I mean, okay, Ed, the problem is I'm looking at this after the market is closed. And so the spreads are kind of wild right now, right? What like the bid ask spread is 42 points. I don't know if that's normally the case if the market is active, but I'm looking at it after hours, so it's just kind of nuts. Okay, I mean the 119 is 64, 165. It's $1 difference. I mean it's just kind of wild. But assuming that this 183, this 165 kind of reflects accurately what the current prices are, you could buy the 120 and sell the 119. You'd pay $18 for each one you buy should Abbott go crashing through, and on Friday, you could turn that $18 into close to $100. It's very rare to be able to sell. In theory, the maximum gain or the maximum value is $100 between the 120 and the 119. But because of sorry, bid ask spread differential, this and the other, you're not gonna get the full dollar. You know, you might get like 90, 95, who knows? And so you might consider that. You could buy 7 of those for the same as or I take the back, you could buy 9 of them for the same price as one of these. But the cool thing is though, is because you're buying a debit spread, the crazy volatility in the price of the option you're buying, the guy that you're selling to, the person that you're selling to, is also paying for the crazy volatility. So it helps you to kind of soften the impact of the volatility because it's a 1 point. I, and I'm making this up as I go, bro. Is that because it's a 1 point differential, they're relatively close, and so in a way, I kind of feel like you're not really feeling the full impact of the volatility, if that makes sense. And so that's one way you could go about it if that would make you feel comfortable, to buy this kind of insurance. So I think you need to figure out what it is that you're worried about. If you're holding the stock for the long term, maybe like I said before, the money's better spent buying shares if it does collapse. If it's just because you can't stand to see your stock lose value, well, you know, I guess. I personally, hold on. So forecasted earnings is $1.07 per share. Seems like the whisper number is also $1.07 per share, so it's kind of in line. Obviously, it's the share price is going to be impacted more by what they say about the future. I get that. I get that. So it depends on what their comments are going to be. Uh, but it seems like Abbott's a good stock and it has an overall buy rating. Right? Most analysts are saying it's a buy. Very few people are saying it's a sell. So I don't know, you got to deliver, but I'd probably just write it. If you're really super worried, you could do this because you have shares. Another way to protect yourself is the following. I don't know why I didn't think about this earlier. I think it was just locked in on your comment about should I should I buy puts. A totally different way to protect yourself is the following. Hold on. Effing sell calls, mofo. All right, I mean, you can sell. I don't know why I didn't think of this. It's your fault because you talked about buying puts. I just got locked in on wanting to buy puts. You could just sell calls to protect yourself. It's what some investors do, right? When they want to make a little extra money because volatility is so high, right? For the exact same situation, if this share price was exactly the same, if we're exactly a week or 4 days away from earnings and everything else in a different environment, these call options would be priced much lower. But because of the crazy volatility, I'm talking about the market volatility, not earnings volatility. Earnings volatility would be the same in either situation, but because of the crazy market volatility, these are much more pricier than usual. So if you wanted to make some money, you could just sell calls against your shares. Like, do you really think it's going to rocket that much? Now, the thing about it is because if you sell just a week out, which is, just a few days away, you have no time really to go defensive to roll. Meaning, let's say the shares jump in price and you're out of position. Let's say you sell the 135 calls, you want to make 35 bucks per share or whatever, and somehow it's incredible news and Abbott jumps up to 140 after that morning on earnings. It's probably going to be very difficult for you to roll your calls to a later time, like 6 months down the road or whatever, and at a higher strike price to not lose these shares. So if you were to play this game, you have to be cool with losing your shares. But I don't know what your cost is. I don't know, but I mean, if you would be happy to take $132 for each of your shares, then you could sell, your calls and make an extra $100 each, and just let it roll. And if it's a good profit, you can get out. But that's a way to go defensive. The difference being is the put option, it costs you money, but you can't lose your shares. The selling covered calls, you make money, but you could lose your shares because once again, you have only 6 days. You have very limited time. So if your calls get blown up, right? If the stock rockets, you probably can't save your shares unless you rolled it out a year. You know what I mean? I mean, even then, if the market continues to rally, you're going to be out of position. I had a similar experience with Google calls. I did that with the 100 shares I had for Google, and I just spent months just trying to battle it. I just kept rolling it out and up, and kept rolling it out and up, and trying to make a little bit of money, trying to get a higher strike, try to. it was kind of a battle. And in the end, I just said, screw it. I just closed them out. I made money overall, but I lost the shares. So anyway, okay, I'm gonna stop rambling. I hope this helped. At least friggin' like the video. Have a good one. Good luck to your decision. Once again, not financial advice, just for entertainment purposes only.